Welcome back. The major market indices head into the final day of the month of May, trading higher for the month. So have investors ditched the sell in May and go away investing strategy? I want to bring in Anthony Chan right now. He is JPMorgan Chase chief economist. Anthony, good to see you. Thanks so much for joining us. So first, give us your characterization of what's going on right now. Do you think investors should be selling now and going away, or do you think that the economy and the backdrop supports investing in equities?
Absolutely. I mean, I think the economy continues to show signs of strength, and in fact, they recently did a study about the sell in May and go away. And if you go back several decades, you get about a 6.7% rate of return if you sell in May and go away. But if you stick around the whole time over the last couple of decades, you get a rate of return of about 8.7%. It's only if you are a super great economist and you can forecast when a recession is going to come exactly and when an expansion starts, that you beat that a little bit by 9.9%. But the average economist doesn't have a 100% track record. So my advice is stick it out.
But there's still expectations that we could see a recession in 17, right? Do you think a recession's on the horizon?
I think there's at least a 20% chance, 15 to 20% chance of a recession in 2017. But to the extent that that means 80% chance of no recession, that keeps me engaged.
John.
Anthony, why are markets rallying right now, right as the Fed is signaling that it could be raising interest rates in either June or July? It looks like markets are responding positively to that. How do you explain that?
Very positively, because the numbers suggest the economy is getting a little bit better. We know that even the Atlanta Fed's GDP now continues to move higher. So we're going to see 2.5% to 3% growth in the second quarter after the 0.8% growth in the first quarter. That means things are getting better. So if the Fed is raising rates while things are getting better, markets are going to be cheering.
The market's responding basically to the fact that the Fed is responding to positive news. They're doing something because the economy is getting in better shape.
Absolutely. And then the other inside scoop is that the markets know that the Federal Reserve will only raise rates kicking and screaming. So if they're going to raise rates, it's not like the old regimes where they raise rates maybe too aggressively. This one, if they're going to err on the side of doing less, and less means it's not going to interfere with the expansion.
Yeah, but Governor, even though things are looking better, the average guy and gal out there, we've talked about this in the past, doesn't feel it. Their wages haven't moved. That's the push and pull that we're seeing right now.
Yeah, there's a big difference between the people whose economy is based on what the market does and based on what their job does. When their hours are being cut back, when the employers are making sure they never go over 40, when their health benefits are cut and their expenses are going up, this is not a booming economy for middle America. It's really, really still painful out there.
Well, the governor is right. In fact, the numbers suggest this has been one of the weakest economic expansions in over 60 years. That's the bad side. The good side is weak economic expansions tend to last longer, but it leaves a lot of people behind.
But you have a presidential election coming up, and S&P, looking back at previous elections going back to the early 30s, found that when there's no incumbent running, the S&P historically underperforms. And you have all of the presidential candidates in some way, shape, or form are talking about potential policies the businesses don't like. Not all of Trump's policies, but a few of the things that he spitballed out there, businesses have been like, whoa.
And Hillary, too.
Yeah, well, that's kind of a given.
Higher taxes, bigger government.
And Bernie Sanders.
But I actually looked at the data, and you're absolutely spot on. When there's no incumbent running, it's a bad year. In fact, on average, the S&P 500 goes down a little over 3%. But the good news is, in the first year of that 8-year presidential cycle, the market, the S&P goes up on average about 8.9%. So next year looks a little bit better. And by the way, this year can't be a great year because corporate profits are basically flat. But next year, corporate profits are expected to be very strong. And even though those numbers are always going to be revised down, even with the downward revision, it's still going to be a better year.
With all this uncertainty around the election, can the market do anything between now and November?
I think the market can give you very low single-digit rates of return, so not a banner year, but it positions us better for next year because no matter who wins the election, and somebody will, of course, next year there will be less uncertainty and corporate profits will be a little stronger.
That's true. Definitely less uncertainty. Anthony, great to get your insights. Thank you so much. Anthony Chan joining us there, JPMorgan Chase.